All right, now for more on China's PPP dynamic, I'm joined by Mildred Warner, live from Ithaca, New York. She's professor in the Department of City and Regional Planning at Cornell University. Welcome to the show.
Thank you.
So just how lucrative could these types of partnerships be for private investors in some of these infrastructure and railway projects?
Well, the thing you have to think about with these, particularly with transportation projects, is what the investor is investing in is the potential of a guaranteed stream of revenue for the next 30 years. That's going to come from the fare box. And so this is very important and a very important source of revenue and potential source of profitability for these firms, because a high-speed rail line is effectively a monopoly. And so monopolies can charge monopoly rents. And in this case, the government is going to allow the firm to set its own prices. And so this could be a very lucrative investment.
So with that being said, we know that these infrastructure projects are used primarily for broad public use rather than for a company to boost their own bottom line. So how can companies balance profit with public interest?
Well, this is the challenge, and in a public-private partnership, it's a partnership between two actors. So the government has to be very clear to specify what are the public values that you want to achieve with this project. In China's case, you want to promote development across the country. You want to build a better transportation infrastructure, speed connections between cities. In the case of the private investor, they have a primary obligation to get the greatest profits they can for their shareholders. And so you have to balance these two things against each other. What we've seen with PPP investment projects worldwide is that they tend to favor more profitable markets, more profitable lines over less profitable ones. That's what you'd expect a private investor to do, whereas government is more interested in evening out the spikes and getting more of a level playing field.
Now, as you mentioned, not all of these routes are going to be well-paying. Some of them are actually going to perhaps either lose money or perhaps will lose money in the future. How can investors adapt to those challenges?
Well, investors are likely to close those routes. It depends on how the scheme is put together. The article I was reading about this particular one is just one line with 9 stops. Now, if they've got several lines, then they can reduce service on the less profitable lines. We've seen this in privatization of railway systems in other countries, where they've cut service to less profitable routes and in some cases even picked up the tracks. That's on traditional rail. High-speed rail is very expensive, and it needs to go to markets where you're going to have very high demand and demand from people who can pay the higher rates that high-speed rail, the higher ticket prices that high-speed rail requires. And so I think you could have some firms going out of business if they're forced into routes that don't have the kind of demand they need to sustain the investment.
So expanding on some of those concerns, what do you see as some potential challenges that could arise with some of these public-private partnerships?
Well, we've seen them already in that they're very complex, and you've got to be able to imagine 30 years forward where we're going to be, because you're essentially locking yourself into arrangement for 30 years. That's a very long time. Can you imagine 30 years ago? We didn't even imagine high-speed rail. So what might be coming on in the future? And sometimes in these PPP arrangements, the private investor is very concerned to protect their risk, and so they'll put in non-compete clauses or some kind of government guarantee scheme to be sure that they'll get a minimum revenue. Well, what if a new technology comes along that makes high-speed rail obsolete? We can't imagine that now because it's the hot new thing, but is it possible to think about that when you think back 30 years? So the challenge in writing, the beauty of a market is that you have competitive actors, and we respond in time relatively quickly to change. The problem with PPPs is they're not a market. They're a contract between a government and a private investor, and they tend to get locked in for long periods of time. So they're not as flexible and responsive as traditional markets are.
And Mildred, just quickly, if you could give 1 or 2 examples of how some other countries are really trying to attract more private investment into public infrastructure projects, what would they be?
Well, the challenge is that the public sector's got a lot of debt. You sort of look around the world and a lot of governments are facing a lot of debt. And we have infrastructure that we need to build. And so the idea is there's a lot of private capital out there. Could you attract it into public investment for infrastructure? Because it is the kind of long-term investment that can hold debt. because it's going to pay out an income stream over time. The challenge that we're seeing is that a lot of these contracts aren't well designed because the government actor is often overwhelmed by the private actor and not quite as savvy in thinking about the long-term financial issues.
Well, thank you so much. We'll have to leave it there. Mildred Warner, professor in the Department of City and Regional Planning at Cornell University.